All right, so we are 5 minutes past, so I think we can jump in. If you are capable and have the bandwidth, feel free to turn on your cameras because it's always nice to see all of your lovely faces. But if you have issues with internet connection or bandwidth, then that's also not a problem. So, welcome back, everyone, to the Women in Resilience Finance Mentorship Program, to this third session today. I think I have one more person joining, Keisha. Yeah, super happy to have you all here. Thank you again for joining. I hope you've all had a good week so far. And, January, or at least the after holiday lull is slowly coming to an end, and you can, feel like you're coming into 2025 um, properly. So today we're going to be focusing on the investor's perspective to resilience finance. We have our partners from GAVA Capital that are going to be presenting today, and we're going to be learning about topics like the context of green finance regarding international regulation and so on, guidelines for approaching inclusive finance, as well as an example of a fund that will be launched quite soon. So just a quick view or look into the schedule for today. I will provide the opportunity for those that didn't have the chance to participate in the first two sessions to introduce themselves. I think there's only a couple participants left that haven't had the opportunity, so we'll take the first couple of minutes to do that. Then we'll jump right into the recap of the session from last week, introducing adaptation and resilience finance. That's going to be presented by the second buddy team. After which I'm going to be introducing our two wonderful mentors for today. And then we'll follow up with the theory applications of today, which is the investor's perspective. And then lastly, as always, I'll finish up the session with a couple of announcements for the upcoming sessions, just to what to expect for the upcoming weeks. So with that, I will stop sharing my screen, and I'd like to invite anyone who wasn't able to attend the last two sessions, just to briefly introduce themselves, provide your name, your background, where you're living, the institution that you're working with, and maybe one or two sentences on, what brought you to apply for the mentorship program and what you're hoping to gain from it. I think, Donna, you didn't have the opportunity to present yourself yet, so I would hand over the virtual mic to you. Donna, I don't know if you can hear me or if maybe you're having issues with your microphone. It is possible. Then maybe we go on to, I think, was it Veronica that didn't have the opportunity to, did you attend the first two sessions? Okay, then.
No, I did not. Yeah.
Perfect. The floor is yours.
Yes. Hi, good morning, everyone. I'm Veronica Manzanero from Belize. I work with the Development Finance Corporation, the corporation's environmental and social safeguard specialist, climate champion. And I also now have been given the responsibility to be the liaison or the lead for any activity that is related to climate finance. We are currently in the process of GCF accreditation. So that's basically one of the main activities that I have been working on. Yes.
Great. Thank you so much, Veronica. Much appreciated. Very, very happy to have you on board and to have your representation. Donna, I think you are having some issues with your microphone. Maybe we can give it another try. Maybe I can try and unmute you myself. I don't think that works. Okay. Yeah, I don't think it's working at the moment. So maybe what we can do is, I see you're
Can you hear me
unmuted.
now?
Yes, we can hear you.
Yeah.
Perfect. Welcome. You can go ahead.
Hi, Donna. I am Jamaican, but I live in Trinidad, so I kind of have a cross-cultural kind of situation. Um, my background is engineering, actually, and I got into renewable energy a few years ago. So my small company deals with finding solutions to the SDG problems, and a part of the whole experience has been the climate change and resilience. So it's actually all rolled into one. So we try to find projects where we can find solutions that are based on renewable energy. And going back to Jamaica, we're looking at some of these resilience projects for women. And so, yeah, I'm very happy to be a part of the team and loving what I'm hearing so far.
Amazing. Thank you, Donna, for being here. You're in the right place, that's for sure. And I think maybe we have one last person, Anne-Marie Xavier. I hope I'm pronouncing your name right. I'm really sorry if I butcher any names today, that I'm not sure if we had the opportunity to hear from you yet. I can see that you're unmuted, but there might be an issue with the connection with the microphone, maybe, because I don't think we can hear you yet. Yeah, apologies, everyone. I know sometimes Microsoft can be a little bit challenging. When I had to download it the first time too, it was quite confusing. Give it a couple more seconds. Yeah, I'm not sure it's working, Anne-Marie. I can see that you're unmuting and muting, remuting yourself. I think maybe you're giving it a try. What we can do is maybe we can jump into the recap of the second buddy team, and you can try out some technical, yeah, see what the problem may be, and then potentially provide you a little bit of time to introduce yourself afterwards. And if it still doesn't work, then you can just feel free to write a short summary in the chat. That also works, not an issue. So with that, I would like to move on to the recap of last week's session that is going to be presented by our buddy team number 2, Natasha Joseph from the Grenada Development Bank, as well as Veronica Manzanero. So with that, I would like to give you the floor. Thank you both so much for providing the recap. And yeah, let's jump right in. Go ahead.
Hi, good morning, everyone. Again, I will be starting off the presentation, so I don't know if you can allow me to share my screen.
I think that you can do it. Yes, exactly.
Okay.
We can see it. Perfect.
Okay, great, great. Let me put it in presentation mode. Yes, great. So I was missing for the first two sessions, unfortunately, but I managed to look at the recording, and I'd also like to introduce my buddy, who is Natasha Joseph. And coincidentally, we realized yesterday that we had already met last year in another session that we were having in the Caribbean. So I have personally met Natasha before. So in terms of the agenda from last week, these were the points that were discussed. I will be doing the recap for adaptation and resilience finance, risks and opportunities in the adaptation finance landscape, and Natasha will be doing the remaining portions. So last year we looked at scope and definition. We looked at the adaptation, the definition of adaptation, and it was basically highlighted that it is a process of adjustment to actual or expected climate and its effects. And we also look at resilience, which is the result of the adaptation process. It is basically defined as the capacity to prepare for, respond to, and recover from the impact of hazardous climate events. And so when you join these two, what you're looking at is a link adaptation and resilient finance that links climate threat to concrete and resilient investment. And so there you see you have the definition of adaptation and resilient finance. And it is defined as any financial service which is provided to an entity. And so along with that comes a series of taxonomies. And for those of you who are not aware, the taxonomy is a list of adaptation solutions that are categorized alongside the risk or impacts. For example, you have parametric insurance in agriculture or the use of climate resilient varieties, for example, in agriculture, in cattle, and so forth. So in terms of the statistics on adaptation finance, which is another topic that was discussed or highlighted, and the reason for this is to emphasize or make improve the awareness of our colleagues on the availability of funding for adaptation versus, for example, mitigation that deals with, energy efficiency, renewable energy, and so forth to, sorry, to decrease the greenhouse gas emissions. So it is very important to recognize that while there is a big need for adaptation funding, there's only 76 billion of that is available and was provided or used in 2023. And also, when the adaptation funding was struck, it was only $4.7 billion. So, on a general scale, there's only 5.8% of global funds for climate finance for adaptation. So, one of the main reasons that was discussed that has been attributed to this is political will. But having developed recently a monitoring and evaluation and accountability and learning strategy, we also realized that there's a need for improved reporting. A lot of these activities are underreported, but even so, generally speaking, the amount of finance for adaptation is very little. And I just did some research last night and just wanted to show you from the GCF website, for example, when you look at the adaptation funding, to get you guys acquainted. These are some of the projects that have been being carried out by the GCF as it relates to adaptation funding, and it includes, for example, increasing the resilience of ecosystem and communities through the restoration of productive. So you can take a look anytime you want to get more acquainted with projects that are related to adaptation from the website. We also discuss the different risks and opportunities that are related to adaptation financing. We look at physical risk, which are the extreme weather events, and I guess from the Caribbean, most of us would know that these extreme events include floods, hurricanes, and so forth. And there's also a transition risk, which is usually as a result of policy or technology change. And I remember last week an example was given, for example, in the use of AI. But in Belize, for example, and this is new information, but I wanted to share this because I think this is a very good example. We are getting in a lot of e-buses, right? And so one of the things that we have had to play catch up on is to train a lot of our mechanics or certain people to be able to service these buses. So basically, that's really like a transition risk because here we are, adapting new technology, but we are not in the back end. We don't really have a lot of people trained to deal with these new buses, these electronic buses. So that's basically a risk. And so when you put these two together, you might be able to have financial effects such as credit risk. People might not be able to pay back their loans. For example, if you're a development bank or any other bank, and also there's the GDP loss. In terms of the opportunities, We looked at analytical studies that show the cost-benefit ratio of adaptation and solution and technology. And for every dollar that is spent, you can make between 2 to 15. So essentially, it really shows the data is there to show the cost benefit or the benefit of an opportunity of adaptation financing. And it has also been highlighted that without adaptation, between 3.2% or 5.1% of the world GDP could be wiped out. And so an example that was given is investing in AI for early warnings or benefits of planting mangroves. These are some of the examples that adaptation financing can bring. But also, if you're working in a bank, you can look at the different sectors and look across and see how the adaptation finance is beneficial in every sector. There's no two ways about it. We also discussed the risks and opportunities and look at the Sham El Sheikh adaptation agenda. And one of the things that was highlighted here in this agenda was the private sector integration of physical climate risk into investment decision. This can be a bit dangerous because we don't want to have or to give people the perception or to be disenfranchised because you are doing adaptation finance and you're being identified that you have a risk and you're being disadvantaged as a result of that. So that was discussed in detail also, and also to a certain extent, the public finance, insurance, and the MDB finance as well. And that's basically it in a nutshell for me. And I will now hand over to Natasha to do the rest of it. And I beg your apologies. I'm just recovering from a throat issue. Thank you.
Thank you
Good
so much,
morning.
Monica. Thank you for presenting, and I hope you're feeling better. Thank you. Go ahead,
Okay.
Natasha.
Can you guys hear me?
Yep, we can hear you.
Okay,
Yes.
awesome, good. Just let me get to share my screen. Okay, are we sharing? No?
We are sharing, yeah.
Yeah.
But you're not in
Okay.
presentation mode yet. So
Yeah. Just let me minimize where you are.
Sure.
Okay, it's not moving. Oh, there we go.
Yep,
All
it
right,
works.
so we're in presentation mode. Okay, great. So thanks to Veronica for doing the first part of this session recap. We looked last week at why adaptation and resilience finance matters. And for me, that hits close to home, being in a territory that's constantly facing threats of climate change. We've had severe droughts, we've had hurricanes within the last 12 months, and the prediction this year is for even more. But the rest of the presentation that was done last week, that part focused on the impact of climate change on women. And we looked at the increasing in temperatures, and it's recorded a 2.2% reduction in work hours worldwide by 2030 would be one of the impacts from the increased heat. And we looked at a video that showed India and women in India and the impact it's having on them in terms of the increase in temperatures. We also looked at climate-related disasters and the impact of those. And the numbers are staggering when you think of what those impacts are worldwide. 299 billion US dollars as the impact from climate-related disasters. And then we went on to talk about sea level rise and the impact on coastal zones. And that again, 400 to 520 billion US by 2100, by the year 2100. I mean, these are numbers that, are difficult to wrap our heads around in the global landscape. But even closer to home, we can think in our own territories, the impact that these things can have. In Grenada, we have coastlines that are already disappearing. Some beaches have disappeared, and it's predicted that if that continues, we're going to lose a significant number again of our hotels, which tend to be on the coastline. Then we also have increased health costs from all the impacts, and of course food insecurity. Farmers are no longer able to plant in the conditions. I'm showing some dry lands here. You can't plant food in these types of conditions. So there's an increase in food insecurity. I mean, the climate change brings across all levels and all types of impacts, particularly on women, who are the ones required in most instances to manage homes. And I have here a photo that was taken in last year. I have a comparison here. This wasn't part of the presentation last week, but I just thought I'd highlight. This is Carriacou. It's a dependent island of Grenada that sits off the coast of Grenada. One photo shows a couple of weeks before Hurricane Beryl passed on the 1st of July last year. And you can see from green to brown, there was an estimated loss of 98% of all buildings on Carriacou. So when you talk about women and having to maintain homes and having to maintain livelihoods and provide for their families under those types of conditions, then the impact of resilience building is critical on women and as we move forward. And so there were some practical examples that were given and policy engagement that we can all be involved in at different levels. We looked at different instruments that been developed. Parametric insurance for extreme heat. That one was sort of new to me and innovative in my mind because we were accustomed to parametric insurance for floods and extreme rainfall. But looking at parametric insurance for heat is a novelty and innovative. When temperatures get to a certain level, then it's triggered, and persons get a payoff. That one is currently happening in India. So those are some of the ideas that can be used. Then we have risk sharing for loss and damage. That one is one that we sort of accustomed to, particularly in our region. I mentioned Hurricane Beryl last year in Grenada. We got a payout of, I think it was 44 million US dollars thereabout within 2 weeks of Hurricane Beryl passing. And that is from a regional collaborative risk sharing mechanism called CRIF as a loss insurance fund. And our friends would be presenting on Gaba Capital this morning, so I wouldn't go into that in too much detail. We'd hear from them. And then we also spoke about the Barbados Debt for Resilience program, where they were able to swap debt for resilience financing. And while that is also to be further elaborated in terms of the projects that they're going to implement, it presents a significant opportunity for resilience building. Mention was also made of Bahamas and Belize, who have their own debt for resilience programs that are under implementation. So there are instruments that are available for scaling up adaptation financing, and these are just some of the examples. We also discussed a bit of policy, the Bridgetown Initiative led by PM Mia Motley out of Barbados, which looks at fairer international mechanisms where disenfranchised and small island developing states can also be able to access greater funding and benefit from what's available. We also discussed NAP as a policy mechanism that looks at cross-cutting resilience strategy to unlock access to finance. Mention was made of Grenada NAP, but by then we were out of time, and so we didn't delve into it. But I can say that the Grenada NAP currently has been revised. We actually have a session next week where we're looking at putting together a budget for the revised NAP. So those were some of the things that we discussed. And I just had this example here because I remember last week when we were discussing adaptation, there was a question regarding the use of concrete for seawalls, etc., as an adaptation measure, given how these how it's produced and whether it's actually climate resilient. But in this photo here, this is an example actually of a project that we did to stabilize a hillside where there were quite a few homes perched on the hillside, and the impact of using a retaining wall, literally, to stabilize the landscape from further slides, because this area has been prone to land slippage and slides. And so I think that summarizes where we got to. There was a lot of other material that was included as additional reading. So I encourage everyone to go back to the presentations that were provided to us and read up on some of the additional measures that are there for adaptation financing. So thank you for your attention, ladies and gentlemen. That summarizes our recap.
Amazing. Thank you both so much, and right on time. That's perfect. Yeah, great job at the recap. You guys did a really good job at just summarizing a little bit the important topics we talked about, and also providing, regional examples and how you saw, the theory that we introduced, how that impacts, your experiences and your realities. Yeah, Donna agreed. Excellent presentation. Natasha, I have to agree with you when you were talking about, the staggering amounts of the losses that have been incurred through the effects of climate change. And if we compare that to the numbers that Veronica presented in terms of the financing flows that are going towards that, it's quite a huge discrepancy. So yeah, thank you both once again for that wonderful presentation. And with that, I will move on to introducing our two mentors for today, Jose Garcia and Marta Juste. Both of you, I apologize also if my Spanish pronunciation is not on top. But our mentors today are both representatives from the Scale for Resilience partner, GAVA Capital, which is an impact investment firm that is based out of Spain. And both of them work at the Impact and Technical Assistance Department of GAVA Capital. Firstly, Jose is the Director of Impact and Technical Assistance, and he leads a portfolio in the Global South of approximately 200 million euros, which focuses on the intersection of financial inclusion, agricultural value change, and climate. And secondly, we have Marta Juste, who is the Impact and Technical Assistance Analyst, one of the main coordinators of Scale for Resilience also, by the way. And she focuses on impact measurement and developmental assistance for the Global South portfolio. So Marta and Jose, thank you both for being here, for presenting, for bringing us into the investor's perspective. And with that, I pass the virtual mic over to you.
Yes, thank you, Benedict. So Marta and I will be presenting. We'll be switching, the spotlight between us. And after such a great recaps, I hope that I will be at the level of these wonderful sessions. So as Benedict was saying, we work at Impact Investors, and so we were invited to give our perspective on resilience and green issues, right? So for this session, we aim to touch these four points. First of all, we want to give you a bit of a context of green finance for international investors from an European perspective, right? Because this, we'll be touching it during the presentation, but now it's changing a bit, right? Like in terms of regulation and general willingness to get involved with green finance in Europe and in the US, as you might know, right? Then we will go into a bit more practical guidelines for an MFI on how to approach finance. As Benedict mentioned, we have a 200 million portfolio. Most of them is debt with microfinance institutions in Latin America, Africa, and Asia. And one of the points we always evaluate is their level of matureness with respect to green finance, right? And we also will explain the Quali Fund, which is a fund we will be launching this year, will be much more focused on green finance. Then, one approach to get involved into green finance, which is we believe is through partnership, especially if you are an institution that green finance is new to you. And then we will give a few examples of, I was mentioning, of funds that are following this green climate finance approach. So let's go into the context. So first, I wanted to give you a general approach to it. So like a private investor looks at resilient finance or institutions, we'll be looking at these 4 blocks, right? So we'll be looking at the strategy, general strategy of the institution, and that means, is there a commitment to have a net zero target, green products and green targets? So how is the institution prepared from like the strategic side and the board and all like the governance side of things? Then the other block that we normally check is their internal risks, and that's the risk from the institution themselves, right? Like from the operations of the institution. And that normally is much more limited because financial institutions do not have a great footprint in terms of energy, water, paper, or emissions of their own operations, right? Like their biggest footprint is always the credit operations they are conducting, right? Like not their own buildings or their own facilities. The other block that we normally look at as well is the external risks. That means how do they incorporate climate or sustainability risk into their lending operations? So that focuses exclusively on relations to our clients and loans or insurance they are having, right? Do they consider it a very important risk for their credit operations, or not so much, and they're still working on a more traditional way? And finally, we look at the level of maturity in terms of products. Have they come with a specific product to generate a positive impact on the environment and on their society, or they're still working with more generic products, right? So every time we evaluate an investment deal, we'll be focusing on what is the level of matureness in those four blocks, right? And as I put there into like a kind of a periodic table picture, this is becoming more a must-have than a could-have, right? Maybe in the past it was a nice thing to have, and then we evaluated positively, but like regulations and also like the lobby of the industry is making all these 4 components more a requirement than a nice thing to have, right? So that's how we see the space evolving. So that's why I believe it's very important for any private or public institution to develop those 4 blocks and advance into the resilience finance methodology. And then a bit about regulation. So this applies only to European investors, right? Which is our position. So from, I think, 2019 or 2020, all European investors are required to report on their environmental impacts, right? So this is the famous SFDR. Then I will ask you if you have heard of it or not, but this is a regulation that applies to everybody. So any fund, even though they do not have an environmental objective or a social objective, they will have to report on their negative impacts on the environment and society, right? So due to this regulation, many investors are kind of putting a lot of pressure on their investees to report on those negative impacts. Then if you declare yourself as a social investor or an impact investor, your requirements are a bit higher. You are not only required to report on your negative impacts, but you are also required to report on your positive impacts. And for that, you have to report on your approach and your methodology to measure those impacts and how you keep track that your investments are really having a positive impact on the environment, on society, right? So that's a new regulation. We are in the first years that we are submitting these reports that are annually. So in our case, that has put a bit of more pressure in our investees on the amount of data and indicators that we'll be asking, right? Because we need to actually comply with our regulator and send all of those informations. So my fair questions to make this a bit of more of a dialogue have you heard of this SFDR regulation or any other similar regulations in other geographies? Have you felt the increasing requirements from investors in terms of reporting, right? Like they are asking more about CO2 emissions, maybe what type of investments are you conducting? So I would like to open the floor and hear you out of about this, right? Have you heard of it? Is there anything similar in your countries? I cannot ask Marta because she is based in Spain as well, so she will give me the same approach. But I don't know. Maybe also be interesting to know if you have European investors or European partnerships, and then if you have felt like this new regulation coming in. Yeah, I have I think someone with a raised hand. Yeah, please go ahead. Right, like.
Okay, sure. Go ahead.
Yeah.
So, well, since everyone else is quiet, I just wanted to say from our perspective here. So we have not seen in Trinidad and Tobago, as far as I'm aware, as far as we're aware here, we've not seen a lot of movement in terms of regulation around investor reporting requirements. But it is something, and we were having a discussion up to yesterday afternoon. It is something that will help us within this region to structure green finance and be able to operate more effectively. So unless colleagues from the region know of something, I myself am not. Thank you.
Yes, thank you very much. Yes, I think, well, in Europe, I think it's been generally good, apart from the, initial confusion about like the requirements for every type of investor, right? Because you have different levels of requirement from an investor, like a general investor, to an investor that is claiming that has a positive impact or that is financing green initiatives, right, Benedict?
Yes, thank you. I'm not going to talk about the regulations that are active in the EU because I also have heard of them, but I know that through my research on the Caribbean region, the Eastern Caribbean Central Bank, I don't know if it necessarily has to do with in terms of reporting on impacts necessarily, but I know that the Eastern Caribbean Central Bank is in the process or has already published prudential standards on environmental risks, actually, and climate risks. I think they were published actually last March. So that could be something that is similar that is happening in the region where we can see a little bit more of a regulatory push happening, a little bit more pressure being put on financial institutions to report on certain physical and transition risks that their institutions are facing. So maybe not so much on the impact side, but definitely on the risk side, I can also see that happening more in the Caribbean region.
Right, thank you. So this has both approaches, right? It has approach from the risk side and has an approach from the impact from the positive side, depending on how you declare yourself, right? Like if you are claiming to have you are a green investor or impact investors, then your requirements are higher. But yeah, I think that's why I mentioned is a must-have for us, and it has stopped being a good to have. Another piece of regulation that affects European investors is the EU Green Taxonomy, right? This taxonomy does not apply to investments outside the European Union. So we are a European investor that is conducting investments outside of the EU. So this is not mandatory for us. But some investors are aligning themselves to this taxonomy as well. So as I think you've been touching about taxonomies before, which is basically a list of activities and sectors that can qualify as green or climate or sustainable. So to put clarity on all the parties involved. So the European Union has published a list of what is considered to be a green investment or a green activity in the European Union. So many investors are aligning their investments and their requirements to their investees to this taxonomy, right? I bet it could be something that is happening in your countries as well, in your regions, that have some kind of a national or regional taxonomies that you will have to follow, or at least align your own taxonomies, right? So that's something there. And then another piece of regulation, though this is voluntary, so aligned to the net zero targets. There's also several initiatives that many investors are following. There are the Net Zero Asset Manager Alliance, the Net Zero Banking Alliance, and the Net Zero Asset Owner Alliance. So there's all these type of alliances where you voluntarily become a signature and you make a commitment to become net zero by 2050, right? So this is a quite common alliance and commitment that many investors are following, GAWA among them. This slide was made I think a month before, but recently there's been kind of a turmoil in these alliances due to the change of the presidency in the US, right? Like many big US investors have abandoned these alliances. So they are now rethinking how to restructure, if they are going to follow the same principles, even though many big investors are abandoning it, or if they are going to, kind of change the things a bit so that big investors can still join, right? Like, so that's something that is happening right now. You maybe heard about it or not. The main investor that withdrew was in the newspapers and everything was BlackRock. There was a signatory of this. And then he decided to publicly withdraw from it. And then the alliance is kind of in a turmoil, right? European investors, I think most of them, they're like very safe and committed to the goals. Because even from the regulations that I was mentioning, it's something important for us, and so there's no big changes happening there. But from this sphere of the US, so we really don't know what is going to be their approach and for the years to come, right? So many institutions use this, right? So the question, the next question for everybody is that if you have heard of these net zero targets and alliances, and if your institutions have policies around becoming net zero in the future. Or is still something that is not really worked. Yeah. Keisha, yes. Yeah.
I'm going to jump in. I actually have a question for you, but just a quick reaction to say the net zero alignment.
I lost you a bit.
Yeah, difficulty hearing you. Maybe you can put up your microphone a little bit. It's very quiet.
Are you hearing me now? It's been a problem.
Yeah.
Yeah, a bit better.
We can hear you, yeah.
Okay. So yes, the net zero alignment, I think is gaining traction, fair traction. A question I have for you though is whether you are seeing within the context of resilience financing any alignment between the net zero targets and the nature positive targets. Are you seeing a growing sort of congruence?
Yeah, there is. Actually, in our case, so we become a signatory, I think 1 year and a half or something like that. So we are in the first stages of developing our own strategy. Well, once you establish your baseline, that means, okay, how many tons of carbon am I emitting yearly through my investments and through my operations? You come to figures that you will only be able to mitigate through generating positive impact through your own investments, right? Like there's no way you are gonna mitigate that through offsetting or buying carbon credits, because it's gonna be quite expensive and also not so useful from a strategic point of view, right? Like it doesn't matter, I do whatever I want and then I buy some reforestation project in some country, right? So the approach to it is that you should maximize the positive impact of your operations for mitigating the negative impact that your operations also have, right? Like, and in our case, so we have a portfolio focused on agriculture and inclusive finance that is generating, of course, some emissions. And through these new funds that are going to be more focused on resilience, we are hoping to be able to mitigate the emissions of the other investments, right? So that we are most level off without using offsetting our carbon credits for that reason, right?
Thank you so much. That was very helpful.
Sure. And I think we have a comment from Donna as well.
Yes, I'm actually, one of the things we were looking at last year is that, well, Mia Motley has been representing the Caribbean for the small island development states. And I think there's a commitment for the non-zero emissions for 2030, but I don't think we're going to be doing the complete non-zero. I think what we'll probably do is we're aiming for reducing the emissions and transmission, well, a transition basically to a low carbon kind of economy. So we'll see what happens. It's a developing thing as we go along in the Caribbean, but I think we're all holding hands for the same outcome, which is to get the net zero emissions for 2030.
Sure. Yeah, thank you, Donna. And I think resilience finance is very useful for reaching these targets, right? Like, because it's a way of, while doing your business, like normal business, being able to offset some emissions that you are having from other sectors, right? So it's a way of compensating from emissions that you are always going to have, right? Because it's impossible to be carbon neutral in some sectors. So if you are going to be involved in those sectors, you are probably going to have to be involved in resilience finance as well to be able to compensate on a more natural way without like going into the voluntary carbon markets. That's why we see it. Okay, and then I'm going to leave Marta to give us a bit more about what is a practical approach for MFIs to follow.
Yeah, perfect. Thank you, Jose. So I'm going to go more into the practical side to see how MFIs can start to approach green financing and what steps should they take. So we've seen that there's several ways to approaching green financing, but recently there has been a specific tool that has been developed, which is the Green Index 3.0. So it's already the third version of the Green Index. It's a tool that has been developed by the European Microfinance Platform, Green Inclusive and Climate Smart Finance Action Group. And it's focused directly for microfinance institutions or financial institutions in general. And we think that it's a quite practical and easy to understand way and path to implement this environmental strategy. And in fact, in GAWA, we are going to directly look into this strategy development for our investees. So apart from helping the microfinance institutions developing action plans, knowing how to develop or how to prioritize the actions to be taken, it can also be useful for benchmarking between our peers to see how the institution is developing in comparison to them. And we think that it can be quite helpful in general, right? The questionnaire is very similar to what Jose introduced. It first focuses on developing the environmental strategy of the institution. Then it focuses on identifying the internal and external environmental risks. So both of the structure of the institution and of their end clients, and how can that affect the institution. Then the management of those risks. And finally, the last step would be developing those opportunities, both financial and non-financial products and services. So that would be like the steps to be taken. But in any case, I'm not going to get too much into detail because I believe that in the following sessions you might see this more in depth, this index. So we are going to focus more on the last part, on the opportunities part of the strategy. So the product development. So there are different kind of products and services that can be developed, financial and non-financial. So for instance, for financial products and services, we can have green loans. So energy efficiency loans, for instance, cold storage powered by with solar power, also solar power irrigation pumps for agriculture, then clean water structures, circular economy, etc. So there's different type of green loans. Also, in sustainable agriculture, there can be specific loans focused on improving the agricultural practices, on having seeds that are more resistant, maybe fertilizers that are organic. So there's different kind of loans that can be provided to help in adaptation agriculture as well. Also, for non-financial products and services, there can be awareness raising, there can be training, capacity building to end clients, so that they can get to know, apart from receiving that financial product, they can get to know how to implement the product itself, right? Or the irrigation system, how can they improve the agricultural practices they are doing, so that they can be more regenerative and they can adapt better to the climate events. So it's a good combination to have both the financial products and the non-financial products and services. Then within the product development, it's important to think about the design of the product. So what variables to consider? One of the most important variables that we internally consider when looking into an institution and their product is the focus on the client. So are they actually serving the client main needs? So it's important to look into the adaptive capacity of the client. So what climate risks can affect that specific client, what financial products and services are more adequate for that client, for the needs they have, the products that they need to acquire. And also there's market integration, and they have a complete, they can commercialize the product properly, right? Also, as you can see in the right side of the slide, it's important to think of what providers and local experts are there in the market. So if we are going to offer a financial product, is there going to be an adequate provider that can exactly offer that product, and that can provide maybe training as well to the client? So that's also an important question, because it's interesting to have also, we will talk a bit later about this, but potential alliances with providers and with local experts. So if the institution is not providing maybe capacity building to clients, it's important that the provider or the expert, if there is a potential expert in the market, they can provide this training. And also to see what kind of product they are giving to the market. What is the pricing? Is the client able to pay that price for the product? Because sometimes there are some climate products that are expensive for the clients, right? So this is also interesting to analyze, an interesting variable when developing this kind of product. And also a more internal aspect to think about when designing this product is the core, the banking core of the institution, the database they have. It's important that this database or this core banking system that can integrate the adequate dimensions that analyze both the socioeconomic and the climate and environmental aspects to the client, so that all these aspects can be collected and a good analysis can be done of the risks of having this type of products, clients, and how can this be improved so that the client is more resilient, what products can be offered so that we can make the client more resilient. So these are general variables that can be considered when designing a product. More specifically thinking about the end client and thinking about the climate risk that this client can have, we can think of the analysis of the climate vulnerability of the client. So this is a mix of different components. One of them is the exposure. So what exposure does the client, the land has to these events, these climatic events, right? So, sorry. So it's important for this, for analyzing this, to know the location of the client. This is basically the location. So maybe to tag the geolocation of the client, and then you get a better analysis about the exposure. Then there is the sensitivity. So what is the crop sensitivity to the climate risks? There may be some crops that are being cultivated, that the client is cultivating, that can be more sensitive to certain risks that are more prevalent in that area. So that has to also be included in this analysis. And then the third part would be the adaptive capacity. So this is more linked into how the client approaches, for instance, agriculture, right? So what practices does the client use? Is the client using very efficient technologies such as automatic irrigation systems, or is the client doing crop diversification, for instance, that would protect the crops, all the crops from being damaged. So it's more about the preparedness or the readiness of the client to respond to these events. And all these variables would compose the climate vulnerability of the client.
Martha, we have just one question from Donna, which was, she was asking, how do we access the Green Index? Is it individual assessment or by country?
Okay, thanks Donna for the question. So this is an index, it's a tool that is open for everyone, and it's an online tool. So every institution can access that tool. I don't know, I believe it's free, but that can be checked. And it's an analysis per institution. So the institution can introduce, well, there's a specific set of indicators per dimension. So for instance, for the strategy, there's a set of indicators to know if the institution has, or up to what step does the institution develop the strategy. There's another set of indicators for identification of opportunities, another for management of those opportunities of risks, and also another for products. So it's a very complete tool. I think that Jose just introduced the link into the chat. And I believe, well, Benny can confirm now, but I believe that you're gonna have a more in-depth session on this index by one of the people that developed it, in fact.
Yes, exactly. Yeah, that's planned in the concrete applications in the second module. So yeah, we're just in the process of designing that session. But yeah, very excited because it's the newest addition to the program. So we will be deep diving into the specifics of the Green Index as well as concrete applications and how you can use it in your institution. So you will be learning more about it in a future session for sure.
Yeah, great. Well, so I continue. Here we have a product example in climate adaptation. In fact, this is one of our investees. The name of the investee is FACES, is an Ecuadorian MFI, and it's an institution that focuses on financing micro-entrepreneurs in sustainable agriculture, livestock, and other productive sectors as well. So they launched Crédito Verde, which is a green product, and it was launched for small business owners. And it's an interesting product because the loan structure has been done in a way that all the terms have been determined, or well, are determined by the environmental performance of the institution, of the end client. So the loan, for instance, the repayment methods, the interest rates are determined by the environmental performance evaluation. So it's a quite interesting example. So the end clients also have incentives for adopting climate smart agricultural practices. So this loan supports climate resilience agricultural practices. So it helps financing these kind of practices and encourages sustainable land use and biodiversity protection. So with this example, the interesting thing is that as the interest rate is related to the environmental performance of the end client, this fosters the adoption of climate smart solutions between farmers. So it's an example that we really like, and we think it's quite successful. And it's also important not to forget that gender lens can be incorporated into this kind of products, and should be, right? Because as you have already discussed in previous sessions, women in rural areas and specifically in agriculture face several challenges that are make them worse off compared to the challenges that men face. So, for instance, they have less access to agricultural trainings and to quality inputs. Normally, it depends on the country, but the normal thing is that they are not the landowners, even though they work the land. So they don't have much influence in the decision making. And also related to all of these factors, they don't usually have the collateral to ask for an individual loan, right? So they can, there's several examples of community, well, in India, for instance, they call it joint liability groups, but like community lending, I cannot think of the word now. But there's example of like more collective loans rather than individual loans for women. So all these aspects generally lead to women having less and less recurrent income and more climate vulnerability. So that's why it's very interesting to incorporate this gender lens into the product. Some potential ways to incorporate the gender lens, for instance, launching directly a product for women, focused on women, or with a minimum percentage target of women in that portfolio. Also offering training, internal training for the employees of the institution so that they understand what are the challenges that women face that are more, that are more related to women in general. Also capacity building to end clients, to women, in financial literacy, in climate adaptation, and other, right? And then it's also good if, in the gender lens perspective, the climate vulnerability analysis can be done in time. So to see how the female clients are evolving and are being less, hopefully less vulnerable to climate risks within time. So here we have two examples of how, or two examples of gender lens products that have already been developed by some institutions. So for instance, to the left, we have a loan that has been developed by SIWA India. So it's an Indian institution that offer microloans to women farmers for climate adaptation tools. And what they do is that these loans are lower interest loans so that the woman can buy solar pumps, drought resistant seeds and water, and can be doing water harvesting. And also they provide the capacity building so that the woman can be more resilient to climate shocks with better practices. And also we have another example that is more related to climate insurance for farmers, for women farmers. So this would be Acre Africa, precisely in Kenya, and they provide microinsurance for female farmers so that they can have stability in climate disasters. So it's a weather-based insurance that can provide quick payouts if there are any climate events. So also it encourages climate smart practices because it's linking insurance with adaptation measures. So these are two different examples that we can see of gender lens financial products. So here I would like to ask you if there's any of your institutions that is offering green lending. Maybe they are already advanced in the development of the strategy, or maybe also having that component of gender lens or maybe also having some technical assistance, some capacity building for the end clients. I don't know if you are we seeing that in your institutions or not? I'm not quite sure about, yeah, sorry, Dora. Because I don't know how many financial institutions are there. I think there's also some consulting firms representatives, right? So I don't know. I think Donna was gonna, I don't know if I interrupted you, but you can go ahead.
Yeah, Donna, you can go ahead. I think you're unmuted.
Oh, okay. So, well, I mean, from my observation and basically my experience, we have I would say quite a bit of this in the Caribbean. I'm living in Trinidad. I have friends in the other Caribbean islands that I deal with, and I'm also Jamaican. So in terms of, especially the climate insurance, the parametric insurance was one of the things that we spoke about, I think earlier when one of our colleagues did her presentation, because we do have a problem with hurricanes and basically dealing with natural disasters. The energy efficiency and the regenerative agriculture, I know it's a big thing in Jamaica. We're working on projects right now for solar power, getting small homes, getting loans approved for small homes to get solar powered energy. So it's an ongoing project, I know, for Jamaica itself. So yes, in the Caribbean, it's a world, it's right across the board. Barbados does it, Dominica, I think everywhere across the board, I would say, is using these support systems.
Okay. It's interesting to see because in other parts of the world, like in other parts of Latin America, in India, we don't see that many, for instance, climate insurance, climate-based insurance, maybe because there's not as many drastic events, or maybe they are not as visible. There's not as many hurricanes or so. So we think that, well, or at least me, that it's more difficult to develop that kind of product in other parts of the world, even though it's very necessary. But there's like a mismatch between demand and supply of that, the business case of that product. So it's interesting to know that at least you're having a variety of financial products to help you with these climate events. That's why
I think that we have a big cheerleader for our region, which is Mia Motley. So COP is something that we follow right across the board, and she basically speaks on our behalf. So whatever programs they have, she shares with the general Caribbean region. So I think that's why I think we're on top of a lot of these programs, at least to help us through our climate issues, etc. So yes, we're working on it.
That's great, Donna. Thank you. And if you have any other examples?
I think we also have Tanya that has her her hand raised. And then, so first let's go to Tanya, and then we'll go to Charmaine.
I think you are muted.
Tanya, I think you're muted. You have to unmute yourself.
Sorry.
First.
Yeah, sorry.
Don't worry.
Sorry for that. Yeah, thanks, Benedict. Thanks everyone. No, so I work for the Conservation Trust Fund. So we are not we're not a bank. We do not do loans, not as yet. So we don't really do any blended finance. So we provide grants. And I would say when we screen the project proposals for the grants, I guess, yes, there is some type of screening that you would also do when you do green lending, right? Just to make sure that the grants are aligned to whichever, climate change or circular economy. So we have both circular economy and climate change grants. But the other thing that I just wanted to touch upon is that we are actually now, we just received the conditional approval from ISF, the INSU Resilience, what is it, ISF? INSU Resilience Fund, where we are going to design a insurance product for reef risks. So meaning the parametric insurance, it will be wind speed, not yet looking at temperature, because we are now thinking how to incorporate temperature because of the heavy damage that was caused last year, actually 2024, with the bleaching. But right now, when we wrote the project proposal, it really will look into wind speed and really look into the effects of disasters and mostly hurricanes on reefs. So the model exists in the Mesoamerican region, in MARFOND, and we are really working together now with MARFOND and WTW, who is going to be the broker of the insurance. I think what would be interesting, and just to put it out there for everyone here in the call, is who is going to pay the premium? The premium will be paid the first year by the donor. So we wrote a project proposal, and ISF, we wrote in the proposal that ISF will cover the premium for the first year and maybe the second. And then in the proposal, we need to look for, the whatever the years after, who is going to pay for the premium. So that, I think, is really the challenge, not only in the Caribbean, but just globally. Like, who wants to pay a premium to ensure that your coral reefs are protected? Is it the hotels? Is it the government? Is it a private landowner who actually owns the land, not the ocean? So that is a whole discussion on I think that we're going to have in the next 2 years on who is willing to support the premium financing. And then, of course, the payouts, our idea of the payouts is that it will go towards communities that will be trained to actually have a reef brigade committee or something, who can actually go after the hurricane and really remove the debris and everything from the coral reef. So that is the really short, I would say, response that we can provide after a hurricane, because it's really the debris and the waste that gets on your coral reef after the hurricane that needs to be removed to ensure that the coral reefs are not too severely damaged after a hurricane. But let me stop there, because yes, we're very interested and to see if maybe in the call also there anyone who would like to collaborate on this one. Thanks.
Very interesting, Tanya. Let us know how the project evolves, because hopefully it's very successful. And yes, the premium, that's always an issue, right? We normally see this type of insurance for specific, like, smallholder farmers or so, and they also have issues with the premium of their insurance. It has to be subsidized or not. And that's, I think, the main problem when making this type of insurance successful. But hopefully you will get the project on board, and good luck with it. I'm sure it will be very successful. Yes, Charmaine?
Hi, good afternoon, everyone. I'm actually with the Caribbean Development Bank. So as far as lending specifically, less so I'll speak about the climate insurance. That's not my strong point. Yes, I'll speak for the Caribbean Development Bank first. As the development bank in the region, yes, I can state that there is already a program of green lending for energy efficiency, renewable energy interventions. We take it as far as the supporting structures to support an energy transition. So we're going as far out then into grid modernization to ensure that the grid itself is sustainable and resilient for both climate change, as well as able to then absorb what is now going to be a bidirectional flow of energy, as opposed to the traditional one-directional flow of energy to the customers. Energy efficiency, both mainly to public sector facilities, governments, those kinds of interventions as well, and the nexus with energy efficiency across all sectors. So nexus of efficiency with, say, water, where you would recognize that the energy to supply the distribution of water can be quite itself a sizable bill in the scheme of things. As far as technical assistance goes, yes, there's also, I'm aware of a technical assistance programs in relation to sensitization for electric vehicles, training on solar PV installation for those partners. Also with a view to ensuring that there's quality control in the deployment of the installations when they are put out. There's always the danger or the concern of ensuring that when you put these installations out, one, they're built well, and then that folks are equipped to do the maintenance after the fact. Because it's all people tend to focus on year one, but there's year 1 through 20 that you have to think about as well. What I can say outside the development bank space is that at least for Barbados, where I am, the commercial banks now, which is also lending, they offer green lending as well for renewable energy installations, predominantly solar PV in the Barbados context. But the business case for that in Barbados is sufficiently mature that the commercial banks are also commercial banks and credit unions, which are not quite commercial banks, but another lending institution, more community-based. They all offer green loans for the purchase of those types of, for the purchase of those types of facilities for residential customers as well as commercial, but there's a focus on the residential partners as well. We recently had electric vehicle tariff changes in Barbados, I think a year and a half ago. So the green lending also extends even into the automotive space. You can get a loan relatively easily for an electric vehicle as well, just taking it all the way through to the end. So yeah, so from the development bank space in the region, and I can speak for the commercial bank space in Barbados, we do have institutions offering green lending. Unfortunately, I can't comment so much on the climate insurance, but thanks.
Great, but in general, the institutions are quite advanced in green lending in Barbados. That's great to hear. Thank you. I don't know if Jonah had something else to add, or maybe it's the hand is raising, but I don't know. Yeah.
That was an accident. My bad.
Okay, no worries. Great, very interesting examples. So thank you all. Okay, so well, I guess we've already touched about taxonomy. I don't know if Veronica was introducing about previous session that you already talked about what the taxonomy is. So, well, it's a classification system that aims to classify economic activities in the sustainable context. So here, what I would say is that the important thing is that the taxonomy is aligned also with what investors require. So for instance, in our case, we are going to have a taxonomy list in our new fund. And I guess it's something that many international investors that are entering into the adaptation and mitigation aspects of climate change, they will require, right? So I think it's something important to consider in your institutions, and also that it's a list that aligns with what investors require. Also, so that there's an harmonization on the activities that are listed. Doing or having a correct application of the taxonomy would lead to adaptation and mitigation actually occurring. So reduction of GHG emissions, CO2 sequestration, and ecosystem restoration. And well, I left some examples here of what kind of adaptation products we can have: organic fertilizers, biodigesters, drip irrigation systems, etc. I wanted to find an example of a taxonomy that has been developed in a Caribbean country. So here we have, I saw the example of the Dominican Republic. They have their own taxonomy already developed. Many countries are starting to develop their own taxonomies. And this is, I guess this is very important because it helps public and private actors within the country and international parties as well to know what kind of sustainable investments can be done in the country or what is categorized as a sustainable investment. So it signalizes what should be done, right? Or what the Dominican Republic considers that should be done within the country. So here it will be interesting to know if you have taxonomies in your own countries that you know about or not yet. I don't know if you have any example, maybe. Or at least we have the Dominican Republic example. Okay, then we can go into the next part, which is the verification systems. So, Jose, the floor is yours.
Thank you. I'm back to speak about the elephant in the room, right? I would say one of the big hurdles and challenges for the deployment of climate green finance is measurement and verification, right? Especially the commercial-oriented institutions and banks and so on. So we have a taxonomy. We know what type of practices and assets are going to be climate resilience, but we need to measure and verify it and report it, right? And that sometimes is a huge cost and burden cumbersome for the institutions, because this is not their normal practice and their systems are not really built for this type of data, right? Like they're normally used to collect much more less data, and the people that is in the data gathering position, which are normally field officers, which are dealing with clients, are people who have commercial pressure, so they are there to close the deals. So they have a lot of other incentives to work with. So for us, this is the big challenge. We think it's key to be able to implement those measurement and verification mechanisms, and then those are integrated into the normal systems of the bank, right? Like, and then we have and it's especially important. I mean, if we speak about energy, clean energy or energy efficiency, it's a bit more easy because we are speaking about assets that you are buying, and then you have some certain specifications that you'll be able to collect. But if we move into agriculture, which is very important for resilience building, then you are actually tracking and baselining agricultural practices that you might require to go on the field and to capture through the system somehow, right? That could be a huge cost and not that easy for field officers to do. So we see that this is a pain point. In our own deals, we use a lot of capacity building and technical assistance to help institutions to cope with these requirements, because this is quite heavy. But we see the approach to integrate into their own IT systems in a lean way, and also understand how to use secondary data, right? Like sometimes you are not going to be able to collect primary data because it's very expensive or has a lot of operational cost. So sometimes it's good to build a system that relies more on secondary data that can be verified, right? Like that is accurate to the context that you are working with. So I have put here an example of a system, which is the JAPU system, that is a digital system that operates in line with the core, the banking core. And so the field officers through this app, they're able to collect, so geolocate the client, analyze their risks, and also evaluate what is the baseline of the agricultural practice, and upload all that data into the system so that can be aggregated and then reported to the lenders, right? Because we are going to be asking about those details, right? And those details are the main barrier for some institutions not to receive climate finance or not to get involved with climate finance, right? Because they see it as very cumbersome. They might have to develop their own app into gathering more data, how to collect that data, and so that it's reliable, right? Like those are the big challenges that are still unsolved, right? And that's is stopping the finance to flow because of the cost of all these measurements. So we in the new fund we are about to launch, we are going to require institutions to deploy a percentage of the loan to verify green solutions, imagine a 10%, and then have a period of ramp up so they can reach the whole amount of the loan, right? Like not ask for the whole loan to be deployed into verify green finance or resilience finance, because that's not going to work if they are not having the experience. So we established this ramp-up period, and then we, of course, support with the technical assistance and capacity building, so they have the resources to develop their own system, right? Because there's not going to be a system that will suit all clients for equally. So it's something that is most likely have to be developed in-house, so that it's not so expensive and cumbersome for everybody, right? So that's a bit our perspective, but we wanted to ask you about your experience with the measurement and verification, because as Marta was saying before, many of your institutions have some type of green loan or energy efficiency, energy generation. How do you experience this as a barrier, and how is your view on it? Or if you are aware how your institution is conducting this, data gathering, right, and this internal reporting. Yes, I guess, Jermaine.
Hi again, everyone. I just wanted to share that in the context, at least of the Caribbean Development Bank, that a part of every project appraisal, at the point when the loan is being when the approach is made for the request for the loan to be initialized, we do have a requirement that we do a results monitoring framework. We want to identify upfront what the output indicators and the outcomes are expected to be, and we're expected to quantify the baseline, the target, the incremental steps to get you there. We're expected to identify the source of the information. And yes, you are quite right. Sometimes it's a secondary source, not always a primary source. Sometimes where it's a case where the capacity isn't there to have primary data identification, that could become a form of technical assistance to build the project management unit as a part of the project. So it develops the client whilst having the work done. And then after that, there's a monitoring and evaluation process that accompanies the life of the project and the life of the loan that would require that data be collected or received from the client to substantiate the gains that were envisaged or anticipated when the project was being designed and developed. So that would cover off the development of that framework on identifying the purpose of the loan. And then it also covers off the follow-up activity once the client gets going and the particular facility, whatever it may be, is up and running. Then that monitoring continues as well. It's a part of the terms of the agreement that these information inputs be received. And then there are also commensurate supervision missions that go along with that as well. M&E is a big part of it too, because we would recognize that, well, the role that I'm in, the bank that I'm in, we manage tranches of funds for other entities as well. So they would have their reporting requirements that need to be satisfied. So the chain is unbroken throughout. And I'll just close by saying it's often been said you can't improve what you haven't measured. So there's always room for improvement, and the data then is able to drive and assist with where you can target where additional work or input or effort might be needed. So just add that on. Thanks.
Sure. Yeah, thank you. Thank you, Chairman. Yeah, we find the challenge, especially with the less mature institutions, right? That they may not be engaged with some green finance yet, or there are more, credit unions or cooperatives that do not have a very big size, and then for them, their systems are much weaker. So for them, this is a huge challenge, right? But thank you for your view. I think you are much more advanced than our traditional investee, but we are happy to see that this is developing rightly. I think we are going a bit over time, so after the verification slide, I have a couple of examples for this is more towards new institutions into green finance. We feel the best way to start doing green finance is through partnerships, and through partnerships, for example, with a very narrow specific green product around an asset, for example, irrigation or solar panels or energy efficiency, right? Like, because all the data gathering, secondary data, and like establishment of the product is going to be much easier for the institutions. Another example, more into the agricultural side, that we have collected is through alliances with farmer cooperatives. For example, you might have a cocoa organic cooperative or a coffee organic cooperative, and want to build a partnership with them to provide finance to their farmers. So then the green and the purpose and all the monitoring of the loans is going to be much more easier because of this partnership with the institution, right? That's our recommendation for institutions that are small in size and new to green finance, right? To start small by pilot and to focus on some partnership that can reduce the cost of developing a product from zero, right? So we developed these 2 slides. You can read in more detail afterwards. And just to finalize, so Gawa Capital is about to launch a fund that is going to be focused on climate resilience and mitigation. This is a fund that is co-funded by the Green Climate Fund. So I think some of you have said that are going through the process of becoming accredited. The accredited institute here in Spain is Cofides, which is the development bank of Spain. So they are the accredited entity, and we are the executing entity of the Qualifund, right? So Qualifund is going to invest on two sectors, mainly microfinance institutions in Latin America and the Caribbean and India, and also climate tech innovators, right? Like, so that's more startups or growth companies that are developing new solutions or new approaches to climate change, adaptation and mitigation. So those are our 2 targets. We are looking at, institutions that are new or starting also green lending. We are not asking for a lot of experience on the product, and our mission with the fund is to enable the tier 2, tier 3 institutions to be able to deploy climate finance. And for that, we have a technical assistance fund as well. So there is grant resources that will go to the institutions to develop their measurement and verification systems, right? So after we give them the funding, they will be able to attract more funding from other financiers and donors. So that's our approach to the fund. We will be starting operations in 2025, second semester, most likely. I'm very excited to do so, right? And with this, I think we can close to not, go too much over time. Yeah, thank you for your time. I don't know if you have some questions about the presentation or so on. You can maybe ask them now. Otherwise, feel free to contact us through email or through Benedict. We will be in touch, right?
Yes. Maybe just to add a small insight or component into the technical assistance part, we also have or will develop gender action plans with institutions, so they can have their own action plan internally of the structure of the institution, so that female employees can get more representation or more percentage of the whole employee part. We are going to track the female board and management representation, and we are going to help to implement better measures. And also in external dimensions, we are going to help institutions try to develop more gender lens products, and that would be with the support of the TA. Also mention that we can keep in contact, because we are now with the pipeline part of the launching of the fund. So we can also maybe if your institution needs financing, we can speak with the investment team to see if you're eligible for the financing. But in any case, we can keep in touch, and we'll be happy to solve any questions that you may have. And also, and this also maybe for Benny, it's interesting. We had some general questions that obviously we don't have time to ask, but maybe some of them can be answered in the next session as an introduction, maybe also on the reflections of the session that we had today. Maybe that could be interesting. But in any case, it's been a pleasure to have this session today with you, and we can keep in touch. Thank you for your time, and I leave the floor to Benny now.
Amazing. Thank you both so much for that great presentation, and also for providing the opportunity to interact a lot and to see sort of what the reality is on the ground for our participants and in their institutions and what their experiences are. So yeah, much appreciated. Thank you so much. I also wanted to provide a quick recap, but seeing as we're 10 minutes over the time already, I'll probably just do so through email. And yeah, great suggestion. I think maybe if we start next week with a quick reflection on those two questions that you provided, would be a good way to kickstart the next session. So I'm just going to go quickly through a couple of last announcements in the last 5 minutes, just so that you're aware. Yeah, you can see I've been in the process of taking a lot of notes. So just quickly on some announcements for the upcoming sessions. So right now we finished the investor readiness one, and next week we will be introducing the topic on green inclusive microfinance and making the business case for the resilience of women. We have exciting mentors that we've been in contact with that will be hosting that session. I think one of them is also actually in this call. So very excited to see you all in that session next week. And just so you know, it will be organized or structured a little bit differently. The mentors wanted to introduce this session as a more of a structured discussion rather than a presentation. So we will ask you to submit a couple of questions in advance, and I'll send you more information on this session tomorrow, along with the recording of today's session and the presentation as always. So you'll get more information on what to expect for next week. But yeah, it's going to be structured a little bit different than what we've seen in the past. And you can expect to be asked questions, be asked to participate, to provide your perspective. That we can have an active and engaging discussion together. For next week, we have also the buddy team number 3, which is Donna Evans-Phillips and LaShawn Wright, that will be presenting the recap of what we learned in today's session. I will reach out to you both individually just to make sure that you have everything that you need, and if you need any support and so on. And also for next week, we have the first informal check-ins. I've sent the calendar invites to all of you. They will be starting next week. And just as a quick reminder that these are just kind of check-ins to make sure that that if you have any questions, to address them, if you have any issues or concerns, to collect feedback on the process of the program in general, and how you're liking it, to improve not only future iterations of this program, but also just to make sure that maybe we can include and incorporate feedback into future sessions of this program or of this cohort, to make sure that, we make it as effective and applicable and concrete for you as possible. And so just to finalize, just a quick view on where we are in terms of the sessions. Next week, we have the 4th session, and at the beginning or middle of February, we'll be wrapping up the first module. And then we have a 1-week break, and we'll be going into the applications 2nd module, where we'll be looking at, more concrete tools and how to develop these strategies that we've been talking about. And just more concrete applications of adaptation and resilience finance. So I think that those are all of my my announcements. Yes. Next week, the session is going to be held on Wednesday. Just a quick reminder, it's not going to be held on Thursday. Our mentors were only available on the Wednesday, so it'll be the same time, 10 to 11:30 Eastern, but on Wednesday, not Thursday. So with that, I will end now the session. Almost 15 minutes over. Apologies for overstepping with the time. But once again, thank you everyone for your participation, for your active engagement. It's always an immense pleasure to see you all once a week. And thank you to our mentors, Marta and Jose, for bringing us through the session today. And yeah, wishing you all a good end to the week or rest of the week, and see you next week. Thanks, everyone.
Thank you,
Bye-bye.
everyone, for your time.
Take good care. Bye, everyone.